let's talk about the financial statement effects of using one of the various inventory costing methods. Remember that each of these methods differ only in the way that they split the cost of goods available for sale between ending inventory, which is unsold items, and the cost of goods sold, which is the cost of sold items. Now, when inventory prices are rising in inflationary times, as was in our example, FIFO produces a larger ending inventory and a lower cost of goods sold. That's because you're selling first the things you bought first, which in times of rising prices were your lower cost items, and what's left unsold are your higher cost items. With LIFO, it's just the opposite. We assume the last things that we bought are the first sold, and the last things that we bought, our most recent purchases, are our most expensive. What's left are our least expensive purchases, those we bought in the beginning. Weighted average cost falls somewhere between FIFO and LIFO, both for cost of goods sold and for ending inventory. Now, why would a company want a lower gross profit and a lower net income? Well, one of the only advantages to making less money is that we pay less in taxes, because it gives you the highest cost of goods sold. The result is the lowest net income and therefore the lowest taxes. Now, the IRS requires companies to use the same method of inventory for tax purposes as for financial statement purposes with regard to LIFO. The IRS does not have this rule for FIFO and weighted average or specific identification. It's called the LIFO conformity rule. Now let's talk about consistency in reporting. A common question is whether managers are free to choose LIFO one period, FIFO the next, and then go back to LIFO depending on whether unit costs are rising or falling during that period. But businesses should be using the same accounting methods and procedures from one period to a next, because that enables investors and creditors to compare a company's financial statements from one period to the next. Now, this doesn't mean that a company can't change its inventory method. However, they have to have a good reason to do so, and that means proving to the auditors that it would result in a better representation of the company's financial situation. The last item on this mini lecture involves Learning Outcome 7-4, or how to report inventory at the lower of cost or market, which is also called net realizable value. Now, this states that when the value of inventory falls below its recorded cost, in other words, what you purchased it for, generally accepted accounting principles require that the inventory be written down to its lower market or net realizable value. And this is a permanent write-down. You cannot write it back up if the value increases later. Now, the value of inventory can fall below what you purchased it for two reasons. Either it's easily replaced by identical goods, which are at a lower cost, or it's become outdated or damaged. Okay, so here's an example for us. We've got some vintage jeans here that you paid $20 for, and now they're worth $25 if you were to go out and try to purchase them today. Sometimes we call that replacement cost. In this case, there is no write-down because the cost is lower than the market or replacement value. But with our leather coats, you paid $165, and now if you tried to buy them today, you would be able to buy them at $150. So because they are worth less from a market standpoint, we have to write down the cost of our inventory by $15. We multiply it by the quantity of leather coats, and then gives us a total write-down of $15,000. The journal entry is directly below. We would debit the cost of goods sold, and we would credit the actual inventory account. Now, that increases your cost of goods sold. And remember, we subtract the cost of goods sold from sales to give us gross profit, and after subtracting our operating expenses, net income. So a write-down in the value of your inventory directly affects the gross profit and your net income as well. Okay, I was wrong. There is one more learning outcome 7-5. And these are some metrics that can help retailers or accountants, anyone looking at a company's books, investors and creditors for that matter, evaluate inventory management. In other words, we're evaluating the folks that run the business. How well are they managing their inventory? And the two ratios or metrics are called the inventory turnover ratio and the days to sell. For the inventory turnover ratio, we divide the cost of goods sold by the average inventory. Now, if you're inside the company, you might have 12 months worth of inventory that you can average. However, investors sometimes only have the beginning of the year inventory, which is last year's ending inventory, and the ending inventory for this year. If that's the case, you can add them together and then divide by 2. This ratio tells you the number of times the inventory, the average inventory, has been purchased and then sold through the course of that period. A higher ratio means a faster inventory turnover. And the faster you sell your inventory, remember, the more gross profit you make. The days to sell, or sometimes called the days sales and inventory, to calculate that, we take 365 and divide by the inventory turnover ratio we just calculated. And this tells you the average number of days it takes from the purchase to the sale of the inventory. And a higher number means a longer time to sell. Now, I can't tell you what a best practice is in terms of inventory turnover ratio or days to sell because it depends on the type of company that you have. For example, when you have a company that sells perishable goods, they tend to buy fewer and then sell them and turn them over more quickly because they are perishable. For example, produce, flowers, that type of thing. On the other hand, a hardware store that sells non-perishable things, nails, screws, hammers, bolts, they aren't perishable. So they might have a slower inventory, a lower ratio, and a longer number of days to sell. So the good thing for a retailer to do would be to compare themselves to other companies that sell the same type of products, and then benchmark themselves or compare themselves to the best in the field. And that's it. You can take a look at some of the problem demonstrations now.